Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney says Canada and China are entering a new era of relations. Chinese Premier Li Qiang says Beijing is willing to deepen ties with Ottawa when it comes to clean energy, digital technology, and agriculture. Both leaders have signed cooperation documents which center around trade, energy, construction, and public security. Qiang says Carney's meeting with President Xi Jinping on Friday will pave the way for upward growth. Home sales across the country ended 2025 on a decline despite lower interest rates. Data from the Canadian Real Estate Association shows the number of homes changing hands fell 2.7% in December compared to the month before. The benchmark home price also saw a dip to below $700,000. The association says the housing market was largely affected by economic uncertainty. Bombardier is one of the best performing stocks on the TSX today. You can see it's up by about 5.5%. The plane maker is expanding its operations in Quebec with a $100 million renovation, if you want to call it that. Bombardier says the investment will see it open a manufacturing center in Montreal that is set to be finished for 2027. The new center will support existing facilities as well as increase production capacity to meet demand. And looking at the markets, it's been hovering all around 33,000 today for the TSX, and it is back up over it. Looking at another possible winning day, it's up 0.33%. And south of the border, everybody bouncing back after a slow couple of days. Tech stocks driving a lot of this, and some banks as well. But you can see the S&P 500 up by 0.57, Dow Jones 0.73, and the Nasdaq by 0.78. With markets trading near record levels, our next guest says a period of consolidation or a pullback would not be surprising. Let's get more now from Greg Halter, Director of Research at Carnegie Investment Counsel. Greg, thanks as always for joining us.
Thanks for having me, Roger.
All right, what do you think we're going to see when it comes to either consolidation or a pullback?
Well, we're not calling for a pullback, but it wouldn't be surprising to see one after basically here in the U.S. almost 3 years of almost 20% returns. So certainly you could have a consolidation. As we know, the markets are volatile. We saw last year we had a big drop in April, and the market shrugged that off and ended up about 18% year on year.
So what would be some of the signs that we might be heading into that?
Always hard to say. I think what's impacted the markets over the last few years have been these events that come as a surprise. Certainly tariffs were last year, and that caused the big swoon, probably 20% down from the top. So it's these events and also, I would say, unintended consequences of some of the actions that are being put in place, primarily macro-wise. You know, you normally don't have one company drive the market, although, as we know, concentration has increased. So if you saw something dramatic with NVIDIA or Google, that could help drive sentiment in the market overall. But I will point out that we've seen a broadening in the market. So it's not just the big names that are driving it, probably over the last 4, 5, 6 months or so.
I was going to say, have people not started to move money around a little bit, maybe balancing things out and calming things down a little bit?
I think they have. There's been this fear over the potential for a bubble in AI, although I'll point out those names are doing very well today. We saw TSM have just amazing results. But certainly names that have been left behind, if you will, like healthcare, have had a really nice rebound. So there's definitely been a broadening. Even the small cap names, equal weight is doing better than the market weight index so far. So yeah, there's definitely been a broadening out, which we think is good. Certainly good for stock pickers.
And so what could be a black swan? I mean, is it Iran if the U.S. goes in or launches an attack there? changes in Russia, Ukraine. What would be a likely factor, do you think?
Oh, that's a tough one because it seems like the market's been telegraphing the situation in Iran, maybe not the markets, but the market's aware of it. So if something was going to happen, you would think you already have some discounting, but that's not being seen in the markets where you've got the general markets close to all-time highs, if not at all-time highs currently. I just don't know. It's going to be, not going to be, it could be something we just are not aware of, and I wouldn't even want to speculate on what that could be and how it gets interpreted.
Okay, and looking outside of North America, what are you seeing? What are the things that are looking positive and maybe some concern?
You've seen a big move in Japan, the markets there, also in China. I don't know if there's any concerns per se, but at least with the Japanese market, they've really gone towards improving maybe the structure of the market, if you will. And you've seen the prices respond, stock buybacks, just getting out of some of the so-called zombie businesses, I think has helped. And that's really driven those markets. International had a pretty good year last year. At Carnegie, we're more focused on the U.S. The companies we invest in have plenty of international exposure. So rather than trying to pick a company where the accounting may be less and you have the currency risk, we tend to stick with the U.S.-centric companies.
And one of the things we've talked about in Canada a lot, defense is getting a lot of recognition. And now down in the States, we heard Trump talk about another $500 billion possibly being added to the defense budget. What does that tell you? Where are you looking that way?
Well, I don't know that he can just throw those numbers out there. They would have to be approved, but of course it's a big number. I mean, 500 billion on top of what's being spent, but you've seen it reflected in names like Northrop Grumman and Lockheed and Raytheon, RTX. DRS, which is a smaller company, the one you had just mentioned before, Bombardier. Any company that's supplying into the aerospace area is doing well. The Eatons of the world, the TransDynes, the Heikos. So there's a lot of companies that have their tentacles into the aerospace and defense markets.
So, but overall, though, you're thinking the year, barring that black swan, could be a good year, though.
Yeah, if the earnings come through and the margins come through, which so far they are based on fourth quarter numbers, and the guidance so far, which is only a couple companies, if we can get a 10 or 14% growth in EPS and margins can expand, why not have a decent year? And, the average is 8, 10, 12% over the last 100 years. Not that anything is ever average in the markets, but certainly that's something that you could expect if those EPS and margin numbers come through.
All right, we'll wrap it up there, Greg. Thanks as always for joining us.
Thank you.
Greg Halter is Director of Research at Carnegie Investment Counsel. Coming up, Nutrien jumps to a 52-week high as potash demand surge. We'll break down what's behind the move right after the break. Nutrien, the world's largest fertilizer producer, jumped to a 52-week high today as investors react to rising global demand for potash. For more, I'm joined by Martin Pradier, the materials analyst at Veritas Investment Research. Martin, thanks as always for joining us.
Thank you.
What is driving this love for Nutrien?
Well, we wrote at the beginning of December that we were seeing the prices of Nutrien really high. And the company is also doing some structural things that are good. I mean, they had a lot of problems in Brazil in retail a year ago, and they have been fixing that. And then they've been in a program of reducing expenses, and all of this is basically very positive for the stock performance.
And it's just, is it just all come together now, or is it just suddenly caught people's eye?
I think that what caught people's eyes is the strength of the fertilizer prices, in particular potash, but also nitrogen prices are probably like 14, 15% higher than last year. Potash prices are like probably for this quarter that is finishing about 35% higher year on year. So it's a very good setup, and there is a strong demand for potash still going on, and even Campotex, that is the association that exports potash for the Canadian producers, has sold all the shipments until the end of March. So you can see that the market is tight, and that's very good for prices.
And what has changed? Where's this demand coming from?
Well, the demand grows every year, like 1.5%, 2%. And it's more like there hasn't been a lot of new supply. And so the market got tighter, and this is very cyclical, but right now it looks very good for 2026.
And Canada, I believe, is one of the largest suppliers. What other countries are they kind of in competition with?
It's Russia and Belarus. Those are the three large exporting countries. And Belarus has had its problem with the war because it used to export through Europe and now has to export through Russia. And so the costs have increased quite a bit for them. So an international market has become a lot less competitive than it used to be.
And for now, but if there was any kind of a peace deal in Russia and Ukraine, could that open up the Belarusian potash again to Europe?
They're exporting all what they produce, but the price at which they can reach international markets is much higher than it used to be, because now they have to train it and make a long train route through Russia instead of a shorter route through the European Union. It's not that certain that even if things change, that they will be able to export as before.
And I'm just looking at some of your notes about Nutrien. They've really picked up on their costs. They've cut their costs, haven't they?
Yes, they've been doing much better on the cost. They have a program to reduce expenses about $200 million, and it was a 2-year program, and they reached that in advance. So at the end of 2025, they had reached their target, which initially was set for 2026. And the other thing, as I said, is retail in Brazil was very bad. They had big losses in 2024. And that being fixed means that the margin in the retail is going to be much better this quarter than same quarter last year. And going forward, you can expect better results.
And also, you mentioned about automation. They're really turning towards automation. Is AI playing into that as well, or is that just simply robotics?
It's mainly robotics, and it's mainly for the potash. I mean, what they've been trying to do is to become more competitive and to make sure that they're close to be the lowest cost producer. And in the case of potash, about 40% of the production is automated. In the case of nitrogen, that is the other big vertical, I mean, where you produce urea or ammonia, they have a very strong competitive advantage because 80% of the cost of producing ammonia or urea is natural gas. And natural gas in Canada is much cheaper than most other places. So because of that, they are one of the lowest cost producers. And that means that they have a much bigger margin than the competitors.
And is that making it look good carrying in beyond 2026?
Yes, I mean, in potash and in nitrogen, they are a great company. They do like a really good company. They've been divesting of some of the things that they had outside of the core and trying to really, narrow their focus to being very good and nitrogen and potash and some retail where it's profitable. And they recently sold, for instance, a fertilizer plant in Argentina. They had something in China. So they have a lot of cash also coming in that is going to be used to reduce the debt.
Okay, we'll wrap it up there. But Martin, thank you as always for joining us.
Thank you.
Martin,
always a pleasure.
Cheers. Martin Pradier is a materials analyst for Veritas Investment Corporation. Coming up, we're looking at oil dropping today and why that's happening. It's after the break. Price of oil dropping today, making its biggest intraday decrease since October due to U.S. President Donald Trump signaling he may hold off on military action in Iran. And you can see oil's off by 4.4% right now, down well below 60 after pushing up close to 62, almost 63 at one point. And of course, it pushed higher in the new year with the upheaval in Venezuela at added geopolitical risk. Now, here to talk about what's next is John Stevenson, founder of Granite Point Research. John, thanks very much for joining us.
Yeah, thanks for having me.
Okay, what's next? What's next? We're week 2 of the year, so what's next in week 3?
Well, it's been up, it's been down. Maybe the next move is up. Honestly, probably if you didn't have any of these geopolitical events, I think you'd have to say that it's going down and probably down for the first half of the year to perhaps $55 a barrel before rallying. The market's oversupplied by a couple million barrels a day. So, what it really needs and what it's benefited from recently has been that geopolitical shock of a possible invasion. And that has huge, repercussions. Not only is, Iran a significant producer in its own right, but the potential for a blockage of the Strait of Hormuz or an attack on neighboring Gulf state oil facilities, all of that is what could drive oil significantly higher. Yeah, but in the medium term, say in the next year or so, it's probably down a little bit to mid 50s, and then up to high 50s by the end of the year. Because I really do think overall it's a much more bullish story for oil as we move forward into back half of 2026 and into 27.
It looks like with these events with Venezuela and now Iran, you kind of see, and then everybody calms down again and people just get realistic about how things are unfolding. With that overproduction, how long can that go on? And are there any indicators they're going to kind of get it back into a more balanced approach?
Well, yeah, OPEC Plus is basically, throwing the throttle, gone to full throttle. And I think it's doubtful that it can continue for much longer. And that's why I say it's probably going to rise in the back half of the year. That's one factor, is just the sustainability of it. The actual physical market doesn't really show that much inventory. So it's kind of a bit of a mystery where these supposed barrels are going. But clearly it's a fear that's weighing on the market. And it's a fear that, the market is taking quite seriously. So I think at some point, the fact that it may be a bit of a mirage, these oil barrels, and the fact that demand will slowly creep forward, assuming the global economy can kind of continue to limp along, or if it actually starts galloping along, that would put a real strong floor under oil, and at least $60 a barrel.
And with the prices where they're at now, what kind of an effect does that have on any decisions about Venezuela from the major oil companies? We heard it was at Exxon got chastised, I believe, right, by President Trump.
Yeah, well, everyone comes in for a little punishment from the Oval Office from time to time. But look, the reality is all the budgets have been set for 2026 by these oil companies. They were set, some time ago. So nothing is going to even begin, to get into the planning stages till 27. So that puts it off for, at least 2 years before you could see anything. And I think, the truth of the matter is the infrastructure state in Venezuela is quite poor. But you go out 3 years and maybe you've got a couple of years of the U.S. oil majors coming back, and they start to invest billions of dollars, 10 plus billion of dollars, collectively at least. I think you could bring on some production and get back up to that sort of 2 million barrel a day or close to it range, where during the 90s, before Chavez came in and started expropriating these properties. And that would be detrimental for Canadian producers. But I think that's at least 3 years out. So I don't think it's going to have a bearing on the oil market for till probably 28, because it's just not that significant. And it remains to be seen, just how bad a state the infrastructure is in and how fast production can come on. I think you can get some short-term production that comes on. Maybe doubling it to 1.6 million barrels a day total output from, say, 800, 900,000 barrels a day, which is where Venezuela is at now.
And with Iran, I mean, the biggest fear, I think, because they're putting out about 3 million barrels a day. I think was the number I saw, 4 million.
Yeah, it's 3.2, and they used to produce 6. I mean, the thing about Iranian oil is it's pretty cheap to get out of the ground. So it's conventional oil, very easy to get out of the ground and inexpensive to get on the ground. So it's highly prized. A lot of it is going to China. All of their exports, in fact, right now, about 1.7 million barrels a day are going to China. So, that adds another layer of geopolitics into the mix. But in essence, they certainly have the capability to do more.
And the big concern, though, if anything flared up with Iran, it would be the Strait of Hormuz. That, what is it, 20% of the world's oil goes through there?
Yeah, 20% flows through there. So it's hugely important. It's a narrow strait. And, maybe sink a couple tankers or something could happen, or, another oil refinery or in Saudi Arabia or somewhere like that. Those would be the sort of threatening moves that people would be very concerned about. Plus, obviously, just, the fact that, it could become a broader conflict. Israel could be attacked, the Fifth Fleet could be attacked, et cetera. So, there are a series of repercussions, but the big ones in my mind are blocking the Strait of Hormuz, impacting infrastructure in the region for other countries in the Gulf region, as well as Iranian production being off for some time. And depending on whether it became a boots on the ground conflict, where it went on longer than you'd think. But if it's an attack and it's over in 24 hours or a week, it's probably a blip. And I think we saw oil push up into the 70s with the Israel and Iran flare up. So I think you could see that happen again if this were to go that route, and it could push even higher than, say, mid 70s. If it was a boots on the ground and protracted situation, then you might be looking at oil trading in the mid 80s. So, it really just depends on what, if anything, happens with this potential conflict. All
right. But for now, cooler heads. John, thanks as always for joining us.
My pleasure. Thanks for having me.
John Stevenson, founder of Granite Point Research. Coming up, now that Prime Minister Mark Carney is in China, we'll look at what's at stake for Canadian canola farmers. That's after the break. Shares of Cogeco are rallying today, up about 3.4% after the company reported higher profit for its most recent quarter. It came in above estimates. Cogeco says despite a challenging radio market, revenue also saw an increase compared to the year before, driven by robust growth in digital advertising. The company has now reaffirmed its 2026 outlook. Shares of Goldman Sachs are moving higher. They're up 4.7%. The lender broke an all-time Wall Street record after posting equities trading revenue that surpassed $4.3 billion US in the fourth quarter alone. Revenue in its global banking and markets division also hit a record for the year. Goldman boosted targets for its asset and wealth management unit and also raised its dividend. Shares of Taiwan Semiconductor are rallying after the chip producer posted profit and revenue in its most recent quarter that topped expectations. Taiwan Semi also given a stronger than expected outlook for the year and says it expects sales to grow by close to 30%. We'll be talking about it coming up shortly. The company's also setting aside $56 billion in capital spending. Analysts note the outlook signals confidence in the longevity of the global boom. And looking at the markets, the TSX back up over 33,000. It's been pushing up through that barrier all day and then dropping below. Now it's up by 0.4%. And south of the border, another good day down there as well. Everybody's in the green. S&P 500 up by almost 0.7, Dow by about 0.8, and the Nasdaq by about 0.92%. With Prime Minister Mark Carney's visit to China, it marks the first time a Canadian leader has been there in 8 years. The milestone visit also has Saskatchewan Premier Scott Moe tagging along. Here to talk about what this moment means for Saskatchewan farmers is Bill Probilski, president of the Agricultural Producers Association of Saskatchewan. Bill, thanks very much for joining us.
Good afternoon. Pleasure to be here.
What would you like to see come out of these meetings, and what are you realistically expecting?
So certainly, ultimately, our hope is that these tariffs on our canola and peas would at some point go away, ultimately, completely. That's likely not realistically, certainly in the short term, but that is ultimately what we would like to see. In the short term, we're hoping there'll be some positive news, at least, coming out of these talks with the Chinese officials that we can kind of have some hope in the industry, which right now there's a lot of pessimism. But there's always that hope that there will be something down the road that will see an end to the tariffs, or at least a reduction in the tariffs that will help to alleviate some of the downward pressure on our prices for our commodity, particularly canola and yellow peas.
I want to talk more about that in just a sec, how the farmers are doing. But what are your thoughts on the premier being there? What is that for show, or are you hopeful that could actually lead to something?
I think the Premier of Saskatchewan being there is certainly a positive step. He's been there before. He knows who the people are that are involved in this, and he's got the experience and the knowledge of how these tariffs are affecting the province as a whole, and particularly in the producers. But that canola industry and the peas in Saskatchewan is certainly a big part of the economic drivers in the province. So I think having the Premier there is certainly a positive outcome.
And what's it been like for farmers since the tariffs were imposed?
Well, certainly there's a lot of uncertainty. Just we've been dealing with these tariffs for almost a year now, and there's a lot of uncertainty as to where are they going, how much of an impact are they going to have on our products, on our prices, on movement of grain. All these things have created a lot of uncertainty in the ag sector. And certainly economically, it's hurt our bottom lines. We've seen the commodity prices come down significantly from where they were before the tariffs. Obviously, there's other factors that are involved in setting those prices, but certainly the tariffs have had a significant impact on those prices. We've seen our input costs continue to rise, and our commodity prices have certainly softened. So it's put in quite a bit of financial pressure on producers in the province.
So they're getting squeezed from both sides right now. Are there alternative? You've had a chance to look. Are there alternative markets, or is the demand is what it is, and this is one of the markets you need?
Yeah, certainly. There's always been other markets that we deal with. China is our second largest market for canola behind the United States. So to replace that volume going into China is almost impossible. Certainly, there's incremental adjustments that can be made into other countries, but to replace that much canola just not practical. So we're always looking at market diversification as an option to take some of the dependence away of our two biggest markets, but we still depend on those two markets to buy a lot of our products.
And any concerns that any kind of deal with China may hurt your relationship with the U.S. and your customers down there?
Yeah, certainly that is a concern. And the United States is still our biggest market for most of our products, or a lot of them anyways. And so I guess it's a bit of a balancing act in terms of trying to reestablish that market into China without causing any undue tension with the Americans. But we need to deal with all of those countries at some point.
It is, but it is a balancing act with them. And if there was a deal signed with China, what concerns might you have about what might come out of that deal from the negative side?
Again, I guess the relationship with our American trading partners in terms of will there be right now there are no tariffs going into the United States on our agriculture commodities, but we've seen that anything is possible going forward. So if this becomes an irritant to the Americans, does that hurt our chances of continuing and expanding trade with that country? So certainly there are risks, but we have to do something. We grow the product. We need to be able to market it someplace.
But are you worried about if Canada works a deal out with China for canola that we might have to give up something that might impact farmers in Canada, maybe some agricultural deals that might hurt Canadian farmers? Certainly,
that's a concern. I don't think that it's a major concern, but it's always there. Everything we do, everything from the quality of our commodities, there's risks involved with our supply chains. We've had issues in the past where our supply chain has let us down, and our customers have gone elsewhere because they couldn't get the commodities in time. So there's always those risks, and certainly in this situation, those risks are there. They're very real, and we have to deal with them.
Okay, Bill, we'll wrap it up there, but thank you very much for joining us.
You're very welcome.
Bill Probilski is president of the Agricultural Producers Association of Saskatchewan. Coming up, we're joined by Matt Bryson to break down TSMC's record-breaking Q4. Being called a historic moment, a Canadian Prime Minister back on Chinese soil for the first time in more than a decade, or nearly a decade. Trade, energy, and the agriculture sector are all on the table. What many Canadians are looking for is movement on agricultural tariffs. CTV's Annie Bergeron-Oliver has more.
It wasn't long ago that Canada called China a disruptive power. Now the language has softened as Prime Minister Mark Carney's government looks to bring stability back to a frigid diplomatic relationship.
This is a new government with a new Prime Minister, a new foreign policy. In this moment of economic stress for our country, it is necessary for us to diversify our trading partners.
And Carney has made it clear that rethinking includes increasing non-U.S. exports through deeper partnerships with countries like China. And over the next few days, the Prime Minister will be pitching Canada to business and government leaders as a place to invest.
I think that this was a really important opportunity to reset the relationship at a time when we're obviously dealing with a much tougher United States and where our Canadian national interests have to be rethought.
A key area of debate and likely disagreement, Canadian tariffs on Chinese electric vehicles and Chinese tariffs on Canadian canola products. Government officials say it's reasonable to expect progress on so-called trade irritants, but the definitive removal of tariffs is unlikely.
Our ultimate goal is to restore market access to China, have more smoother, predictable trade with our number 2 export market. And so we're looking for signs of progress and resolution on that front.
This trip is all about getting business investment. So far, there are no cultural or heritage events on the schedule. Carney will spend his first full day in Beijing meeting with business leaders. Then he'll transition to China's Great Hall, where he'll meet with government leaders, including the Premier, and participate in 2 signing ceremonies related to energy and climate change.
That was CTV's Annie Bergeron-Oliver. Well, Taiwan Semiconductor Manufacturing Company announced record-breaking fourth quarter profits, up over 30%. The record high has reignited interest in not just the company, but the AI industry overall. For more on this, we're joined by Matt Bryson, Managing Director of Semiconductor and Hardware Research at Wedbush Securities. And Matt, thanks very much for joining us.
Thank you so much for having me today.
What did they do right? That's quite the number.
I mean, it looks like they did everything right. But more seriously, AI and accelerators for data centers has been what's been driving the TSM sales growth. And it looks like the same thing happened in Q4. And not only did AI drive stronger growth in Q4, but it also looks like that's going to be the case through 2026.
And they want to spend. They need to build. They're going to build out more, aren't they?
Yeah, they have to. They are the sole provider of high-end chips, and their customers are seeing incredible demand. And so TSM is spending to support those customers.
Now, can that be almost too much of a good thing? Can they meet that demand with the plans that you're seeing for them, where they plan to go this year?
I think there are bottlenecks across the supply chain. I don't think it's so much Taiwan semi. So we're seeing shortages of memory in particular. So both the DRAM and NAND are constraints on system builds. Over in Taiwan, you're seeing something called T-glass, which is short, which prevents the manufacture of the substrates that these chips are manufactured with. So there are lots of constraints. I think at the end of the day, it's not going to be TSM's capability of manufacturing that holds people back.
But if there's nowhere to go if the other delays, could that have an impact on them, though?
They said that they don't think those bottlenecks will impact their business. But I think if there are bottlenecks, it will be those other products. Now, having said that, what we see when products are in short supply is you see a shift towards the higher value chips, if you will. And so from a Taiwan semi perspective, they probably capture more and more of the value because, again, they are producing the most advanced semiconductors on the planet.
Yeah, and one part of their expansion, I guess, is they're looking at the U.S. Is that political, or is that actually good for business?
I think it's a little bit of both. So certainly customers away from the U.S. desire for manufacture, they want to diversify risk in a world where there's clearly geopolitical tension between China and the U.S. U.S. manufacturing allows TSM to meet that demand from their customers. But at the same time, I don't think it's a bad thing to go and build out a ton of factories in the U.S. when you have a president who very much wants to see companies supporting U.S. manufacturing.
And it brings a lot of it closer to home. With everything that's going on, we've heard talk of bubble, frothy. What does this tell you about the tech sector and AI?
I mean, I think it tells you what at least I've been running into over the last 3 to 6 months, which is if there is any froth, if there is a spending bubble, we're not going to see that froth come to an end in 2026. You're not going to see that spending bubble pop in 2026. I think throughout the story of AI since ChatGPT 4 launched, the reality has been we've only been able to see about 12 months out. And there's always been concern that, yes, we can see the next 12 months. It's what comes beyond that. I think we're still, to some extent, in that reality. Having said that, what we can see looks really, really healthy.
All right. Is it a potential headwind for TSMC with the big tech companies talking about making their own chips? Is that realistic?
So, I mean, Google definitely is having success with their custom ASICs. With TSM, the great thing about TSM is it's not like you have to debate between should I own Google or Broadcom because they're manufacturing Google's TPUs, or should I own NVIDIA because you look at all the major suppliers out there. NVIDIA uses TSM, AMD uses TSM, Broadcom uses TSM. So Marvell uses TSM. So by proxy, Google and Meta and Amazon and Microsoft, who all have their own chip ambitions, they are all fabbing through TSM. And so TSM wins no matter what direction people go in.
All right, we'll have to wrap it up there. But Matt, thanks very much for joining us.
Thank you.
Matt Bryson is Managing Director, Semiconductor and Hardware Research at Wedbush Securities. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Check out some of the movers south of the border. And for that, we're joined by Bloomberg Equities reporter Matthew Griffin. Matt, always a pleasure to have you here, sir. They're popping the champagne at Goldman Sachs, aren't they?
Yes, Roger. Goldman Sachs stock is up as much as 4.8% today. It's trading at record levels after their quarterly earnings. There were several areas of strength in the print. One that's really notable was equity trading. The bank hauled in $4.3 billion, more or less. That's not just above expectations. It's actually the highest ever in the history of Wall Street. They also had strong investment banking fees. They raised their dividend. So that's really cheering investors. It's the latest sign of progress for the bank under CEO David Solomon and helping them avoid the sell-offs that have hit some of their peers this week.
Yeah, we saw a few drop after their reports. Was there anything bad in this?
It's actually not really something that came up in my reporting, in my reading. I think there were puts and takes on some of the smaller items, but a lot of optimism here. For example, you saw really elevated concerns about costs. For example, at Wells Fargo, their stock slid. I think costs were in focus at Goldman Sachs, but not the kind of real black mark that it was for some of the peers.
All right, so it's the report card you bring home. You got a B in art, but you don't really worry about it that much. SanDisk target raised at benchmark. Easy for me to say on growth margin potential. It's the end of the day for me right now. Tell me about SanDisk.
Yes, so Benchmark's price target hike here to about 8% above where the shares trade now, so even further after today's rally, comes as the market for memory storage, basically data storage, is strong. SanDisk, a major player in that market. Another thing lifting the shares today is that strong outlook from TSMC that you were just talking about, which is basically showing that the party in AI is rolling on. So why does TSMC's outlook matter? Why is Benchmark hiking their price target on a connection to AI? Well, when you're training AI models, you need large amounts of data. That means you have to store that data, and that has pushed up the prices of the products that SanDisk sells and pushed up the stock along with it. It's up about 1,300% since last April, last time I looked just a few minutes ago. So that's a really blistering rally, and Benchmark saying that they see more upside here.
All right, I remember buying those for my digital camera 20-odd years ago. Holy cow. Okay, shipping from Matson Gaines. People happy with that right now?
Yes, Matson is a shipping company that's been really interesting to follow over the past year. They offer sort of a premium service between the U.S. and China, so they're competing both with air freight and traditional container shipping. But if you make your revenue shipping between the U.S. and China, you've faced some volatility over the past year during the trade war. Their shares were just hammered as Trump raised tariffs in the spring, as he threatened 100% tariffs again in October. But the company had some commentary out today that was positive. They said demand between the U.S. and China is strong. There's strong e-commerce demand and also lower uncertainty on both tariffs and port fees after the trade agreement between the U.S. and China in the fall, or really more of a truce, you could call it. So the stock rising today, up about 60% since October when Trump was making those fresh tariff threats.
Okay, we're going to have to wrap it up there, but always a pleasure. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us. Have a great day.